Welcome, everyone. Looking forward to spending the next hour and a half with you to give you some ideas on where we think the market's headed. We have two purposes in this. The most important is to give you a few investment ideas that will hopefully make you more money with less risk. And the second is to be entertaining, because I hate boring lectures, and I'm sure you do as well. We're doing something a little different this time with our company sponsor presentations. If you're anything like me, I'm pretty zoomed out. So it's hard for me to listen to a 20-minute presentation. I'd rather just very often just read it. But what I've done is presented 6 companies that we like a lot and asked them to give you a 5-minute overview. And they'll be interspersed, if not all at once. So you'll have ideas that you may like to invest in or to track. As you can see, we have a very, very, very active program. We're going to cover a lot of items. And because of this, we will be recording this and then posting it on our website, our YouTube website. So no need to take notes. If you miss something, we'll have it there, and you can simply review it or invite your friends and colleagues. Usually in these webinars, we have anywhere from 100 to 400 people presenting, and then thousands catch it over the next couple of months. We think it's all worthwhile. What we're going to do is start with our review of major forecasts of last year, give a high-level preview of next year, talk about gold, which I like, being a Leo, then reiterate our desert island pick, which is, if in 2003, I was away for 2 years just fishing and eating on coconut, and came back in December 2024, didn't care what happened in between, what would have made me some money. So we'll reiterate that pick. We'll talk a little bit about some of the financial astrology notes that we have, the overview. We'll give you the 5 strategies that we use, and you don't necessarily want to use all 5. We'll give a few specific stock and commodity recommendations that we like, some of which may be appropriate for you. We'll be having 6 company presentations, just a quick brief overview. If you like them, of course, I suggest going to the website, downloading their full presentation, getting on their email list, or putting it on your trading screen. And I've spoken to a few of the companies, they wouldn't even mind if you became shareholders. And then last year we had one company we presented, which we'll talk about, that went from 60 cents to $3 in about 2 weeks. This time we decided to give you 5 companies. That's our champagne portfolio, one of more which may do something similar. And we'll have closing remarks, review, and of course questions and answers, which is why most of you are here. Any questions you have, please put in the chat box. No reason to have anything else there. I don't even look at it until we get back to the end of the program. And of course, we'll answer whatever we can. Disclaimer, obviously, you have to do your own research. Obviously, we're not necessarily going to tell you something that we're in or not in. And many of these companies we are invested in or have been in and out of, depending whether you're trading or investing. But of course, you have to do your own due diligence. If you're a newbie, you may want to ask for some professional advice. Never a bad idea. So again, this is a basis, one thing that you can do to look at, but not necessarily to follow every piece of advice. So we're going to start with the high-level forecast of last year. And there are 5 that we thought. One is based on astrology. We'll talk about it in a moment. One, which some people note that we did not have the bear market we expected. What we discussed about Fed interest rates, and then a few other things. So let me go with what I consider the 5. The first thing is this. From the astrology viewpoint, roughly in April, October, we were expecting 2 major events in the marketplace. What were these events? If you look at the very bottom of the Hindu coast, one of these events we felt would be a little bit like the October 1929 crash, and the other one would be like the terrorist attacks. Now, both of these happened within a month at the time. We had the financial crisis. Didn't happen. The markets did not respond the way we expected them to. And of course, we had, unfortunately, the situation with the Israel terrorist attacks, which was very much like 9/11. And when oil went up on that, obviously it hasn't gone the right way. So from the viewpoint of the two major events, type of events we're expecting, we were correct. However, the market did not go into a bear market as we would have thought. Partially because of the Magnificent Seven, which has been most of the market. Generally speaking, the average stock is up 5 to 7% or less. Many of them are down, but these 7 are up massively. So it's a different type of market, again, depending whether you're an index or whether you're trading stocks. Do realize that the risk always remains that when things, if and when things correct, and we'll talk about when we think that can happen, you can lose 40% of your money if you sell. If you hold, that's a different story. The market is not always right. The market kept on saying all year that the Fed was going to lower rates in 2023. We said absolutely not. And of course they didn't. They kept on giving signals back and forth. So one of our big trades, of course, was shorting the bond market. And then we had our usual sell in May and go away. And we did get to 41.69, which is where we were at the end of May. So if you didn't want to be in the markets from May till October, you were fine. Of course, you could have stayed in as well. And then the timing of gold and silver, because we like precious metals, we like them even more going forward. And the timing on there was excellent. For those of you that follow our Twitter account or our clients, you know that we were buying gold well under 2,000. We were buying silver well under 22. We were buying copper, we missed. We were looking for copper from 340 to 360. We got to 360, but then we, instead of doing what our system recommended, which is to buy at 360 half and buy at 340 half, I didn't do anything hoping for 340. Sort of a trading mistake, but we didn't lose money. And of course, U.S. bonds were brilliant. We were basically from 340 on. We got out at 420 to 425, and of course it did go higher, but nonetheless, a very good trade. And with oil, we did very nicely. We kept on buying it on weakness, and we got out at 92, which is the numbers we gave. So our trading positionally did extremely well, which means we did well. So we're reasonably pleased with last year. Now, going forward, we are somewhat uncertain because of the mixed trends. And because of these mixed trends, we're going to take, as usual, a very, very long view and a very, very short view. Such as yesterday when we were shorting the market, beautiful move, 70 handles, but by our system we had to sell half, and you see today at least was a half retrenchment, maybe all the way, although we're reshorting anyway. So because of the uncertainty, we have very short time frames or very long. The intermediate ones, especially if you're going against trend, are difficult. So for various reasons, we have a repeat that the markets don't seem to be concerned with multiple issues, not that there aren't always multiple issues. We've talked before about how it's different this time than what you read in books 20 years ago or 30 years ago. Markets are very different because of ETFs and computers, retail, environment. And also that it doesn't always reflect fundamental reality. But there are two new wrinkles we have to put in. And that is the breaking of the rules. The Swiss, for example, last year on the bank failures, favored shareholders over bondholders, totally without precedent, for the reason that you accept lower returns from bonds is because you're supposed to have primacy, absolutely beyond the keel. And when the markets in the U.S., the financial markets, we broke the rules, and they gave insurance to everyone. Had they not done that, of course, markets would have gone down as they should have or could have. But instead, everybody was insured. So basically, you have to be very careful because the rules change. And then the second thing is a new growing impact of AI. That's different than computer trading, and it has a different effect. And it's just beginning to be built into the marketplace. So it is different this time. So what are the key questions that we have to ask and that we have to worry about? First, is there a soft landing or recession? We don't think of the soft landing as true. We see a recession. But again, it's bifurcated. Parts of the market are going to do very well. Parts of the market and some people are going to do very well, and some people are not going to do well. High interest versus high growth. Right now, everyone thinks interest rates are going down. It's possible. It's possible it's not the case. There's risk there. Normally, we prefer stock picking to index investing, although this year index investing did extremely well, although I think our stock picking did better, but the index investing was fine. Will 2000 be good or better than 23? We'll talk about numbers. And finally, for the first time in a while, normally we sell in May and go away. We're probably not going to this year. We're probably going to stay in the markets then, and we'll give the reasons why. So it's a little different, but there are a lot of open questions. What are the considerations? There are the four big known unknowns. When will the Fed lower rates? Everybody has ideas from March to September. Some people say 2, some say 3, some say 4, obviously at least 2. We think probably in May and probably in September. There may be others as well, but those are the two we're betting on. The issues of the Ukraine and Israeli war, whether they get expanded, God forbid, or whether they reach some sort of stalemate and the killing stops. The big risk to the U.S. markets are the dollar alternatives. The fact that, for example, that a lot of trade is not going to be in the dollar, is going to be very inflationary. We've lived on, for many, many years, post-World War II, on the fact that the dollar was a global currency. Now many local currencies, even the petrodollar, is no longer sacrosanct. That has a lot of effects, not only in terms of the hard assets like gold and silver, but also inflation in terms of goods. And of course, a U.S. presidential election. Usually they throw out everything they possibly can to make markets up, and almost always in the fall that the gasoline prices go down, partially because of usage goes down after the summer, but partially because of, shall we say, manipulation or interest in the parties that be to have, at least on the short term, lower oil prices. Has the market peaked? In my viewpoint, more or less, that is to say, between 4,800 and 5,100, which is current high targets. Always people have outliers. So we would say that we're pretty close to the top, if not at the top, and yesterday's could have been the top. You know, we're constantly playing this like a broken record, taking some profits and then coming back in. We were alternating between inflation and recession and a soft landing. I don't think people are concerned with inflation, but I think it's sticky. So we have a slowing economy without question, and we'll have both inflation and deflation, bifurcated market. Generally speaking, profits for companies will not be higher, and the market is rewarding, at best, companies that are firing people. That's good short-term palliative, but not good long-term. Because the financial landscape is increasingly complex and unpredictable, we're only interested in certain times and plays. So even for me, because of what we see as increased manipulation, we're going to be playing very certain segments of time and then taking very long-term views. This is the reality that you're going to see next year for most consumers. It's not, food prices are up, energy prices are somewhat down, but I think they're not going to stay down. But even so, on a 2 to 3 year basis, many people are going to be squeezed. On the other hand, as you know, other people will not be. So let's talk a little bit about the market risks that can trigger a downside. First, we have real estate capitulation, which everyone was expecting in 2023, but as more becomes due, we're going to see more people handing back the keys and letting go of their loans, not just in San Francisco, but all across the U.S. and many places globally, because we're not going to have zero interest rates again anytime soon. So real estate capitulation is going to be one thing. We're definitely having declining earnings. We definitely have an LEI that's going down, and the money flows until the last week or so has certainly been primarily negative, but people want their bonuses, so they're going to do whatever they can to keep the market up until the end of the year, and I don't think they're necessarily going to do that next week. So we're going to be hitting it tactically, shorting the markets, but if there's a problem, we'll talk about how we deal with it. So we definitely either have a recession, or slowing growth. What we also have is tightened credit. Banks are tightening up credit, and interest rates are not going down as fast as the Fed. So unless you're A1 credit, it's being tightened and cut. Why will inflation be sticky? Today's news. Southwestern Pilots is getting 50% increase in the labor contracts over 5 years. Many labor contracts got up 40%, and there are many people who are not sharing it. So we have the haves and have-nots. Some people will be staying ahead of inflation, other people will be falling behind. And that will mean different segments of the economy will do well, different stocks will do well. We also have increasing regulation, especially when markets go down, which they haven't yet, but we do believe so. You have the geopolitical complexities with also increased regulation, and then are always the swan events that can happen. So there are a number of market risks. So we worry, not what we worry. But always there are market opportunities, and that's something very important. So we don't want to be frozen into doing nothing. We're patiently bullish on gold, even though it's a little above what we think it's worth. It's constantly being worth more and more, and especially if the U.S. dollar loses more of its glow. Even though the Argentines saying they're going to dollarize their economy, it's not enough compared to Russia, China, Saudi Arabia, UAE, all paying less and less attention to the U.S. dollar. So that's a very positive sign for gold, which we'll talk about. The stress of M&A has been doing well. I think it's going to do better. It's not as widespread as we would have thought, but it's there. Because of the upcoming election, there are winners and losers. You may get lucky if you stay in the index, you may not. We like hard asset inflation, even though they're saying there's no inflation. We believe it's sticky, as well as underreported. And we like dividends. You never go wrong with profitable companies with pricing power, never, on a long-term basis. And special situations, which we like. We like to spend the time there. So what is our market approach and our recommendation to everybody? Great caution is our keyword. Right now, everyone's saying everything's wonderful, things are going to go great, we find that as valuable and as useful advice as saying the Fed's going to lower rates in 2023. There are physical and economic challenges, lots of risk. That doesn't mean do nothing. It does mean raise your cash levels, but it doesn't mean that. The most important thing that we can advise is what we said last year, even though it didn't happen, is to have the ability to buy if and when there's a market panic. If you were not able to buy in October 22, when the markets were way down because you were margined or just had no cash, that is the problem. So make sure you have the ability, should markets drop between 10 and 20% or 30%, or certain stocks go 30%, because they all won't drop that much. You have to have the ability to it. And then, if you don't want to be an index person, and you don't want to time markets, there are going to be a lot of winners and losers, and we can see that. A lot of favorite stocks, certainly a lot of the biotechs, certainly a lot of the drug stocks did very poorly after what was the COVID times. Globally, we're changing our focus, and this is an easy one for you all. Years ago, China. Then we went to India, which is, by the way, at record highs. And now we're focusing on Canada for 2025. This is a big focus for us, Canada-based companies, which we think will do better than the Indian and the Chinese. Why do we want that? There are multiple reasons. First, astrology, of course, looking at the horoscope of Canada and the Canadian markets. The second is the loonie is cheap. So when I was just up in Vancouver, I would pay something that was $100 in the U.S. I'd pay $100 in Canada, but it was only $70. So it is a close to 30% advantage. It's a rich, resource-rich country with everything from water to minerals. And especially because of the Inflation Reduction Act, those of you that are into mining, like myself, there's going to be a lot of money going into the mining and battery sectors. So there's a lot of reasons to take a look and overweight Canada, however you do it, if everything's equal. We'll talk a little bit about gold, which did well, but not only did it do well in the US dollar, but imagine you had it in a foreign currency. If you had it in the euro, if you had it in the yen, if you had it in the Argentine peso, clearly you would even did far greater than the Americans did. Now, many people think that gold has to be of 2,000, other people say 2,100, to be off to the races. I think that's a major reason, but there are other reasons for gold to be strong besides that. But that obviously, if the dollar becomes weak, gold will do well. So we liked it. Actually, silver, again, while we like silver a lot, and I think many of our companies are well undervalued, I think because we're in a recessionary, slow growth environment, that gold will slightly outperform silver, which means that the gold-silver ratio will tend to increase. But we like both. And we are long both as an investment. So we invest and hold, we buy and hold it, and also as a portfolio hedge. Numbers that are certainly very possible this year are the 22 to 24 level and $30 silver, although there's a lot of resistance at 22 and there's a lot of resistance at 30. And of course, we could go higher. We've given these 5 reasons before. It's cheap geopolitical crisis insurance. If you can't buy the US dollar or don't want to buy the US dollar, you want to hedge it, gold is the best thing. Some people think Bitcoin is as good. I don't think it's as good, but certainly gold always works. It works in a number of ways. And if you pick good stocks, although there's more risk, in an up market, it will outperform the physical. So a good gold stock will outperform the physical gold. A good silver stock will outperform silver. It's got a good dynamic, but should they go down, then you have more risk. Okay. Currently, and this number keeps going up almost daily, it's under 2,000, our value. As a commodity, it's worth a little under 1,800. As a currency, it's currently about 2020. As an inflation level, and that one's going to change a lot. It goes up and down. And as a crisis metal, it keeps changing. So, but at the moment, it's worth a little under that, which means it's a little overvalued. Silver is undervalued, but not by much. However, we think the stocks are undervalued. So the support levels remain the same. Obviously, for gold, it's going back to 2,100 or 2,200. For resistance, obviously, support could be as low as just below about 1880. We don't think it could go lower than that. And silver, obviously, the 22 support, but 24 is pretty good here. So it's got a lot of support in the 24, 26 area, and then it needs a reason to get to the 30, 35. However, computers can do anything. As we know, we can have natural gas at $10 one year, and we can have it down to pennies, $2 the next year. Same thing with oil. You can have it up to 150 and then go to minus $30. So remember, as computers rule the game, Those are usually very short-term positions, which you have to take advantage of. But remember, computers don't think about fundamentals. We've talked also about central banks buying. I think that's one of their ways they're diversifying from the US dollar. If it becomes a popular stable coin, then there's certainly a minimum of 2,500 up to 3,000 to 5,000. An international gold currency will value gold probably around 4,000. We don't know when that will happen. And also retail interest in the U.S. Obviously, there's been interest globally, but we see Costco now selling gold coins in the U.S., which has not traditionally been a big buyer. So I think you're going to see much more U.S. retail interest. Obviously, you've had it in Asia. Obviously, you've had it in the Middle East. But I think there are reasons you'll see more in Europe and more in the U.S. And institutional as well, which is not very much there yet. When will precious metal be favored sector? I think it's just beginning. We believe before June 2024 that it will be talked about more and more. And it depends on which brokerage house you have, but you're going to see it more and more by more brokers. We have 7 reasons. One, of course, is positive astro. And secondly, we have it positive at least into February, and we'll talk about that. If the 2004, some people say 2100, is established and we're only going up, then of course it will be highly popular. U.S. dollar weakness, either accompanied or unaccompanied by brick competition. If there's a gold stable coin, if unfortunately there's some very heavy crises that could happen. And finally, the most interesting thing, which may or may not happen, is algos trade inflation as negative for gold. Yet every gold investor at any conference you go to, one of the reasons they buy gold is for inflation protection. Doesn't help miners as much, but it does help gold. So when the gold changes their mind, which algos do every once in a while, that would be making it very popular. But I think more the reasons are 1 and 2 and 3. The top, actually 4. The top 4 are enough reasons. So we think by before our August 19th seminar, gold will be much more popular. Okay, we're going to give now my desert island pick, which is a silver company. So give me a moment. It's a presentation. This is a company that we like.
Hello, everybody. Welcome to Mag's.
1 second. Whoop. Let me get out of this. Give me a moment here. I've got to do a bunch of things. I've got to shut myself off.
Hello, everybody. Welcome to Mag Silver, a leading-edge North American Tier 1 silver company. I will be making some forward-looking statements today. And really what we always like to say at Mag has a history of turning forward-looking statements into facts. Mag, we have 3 assets. We have the Juanicipio project in Mexico, which is a Tier 1 silver producing mine that is now at nameplate and is online generating free cash flow for Mag. We have the Deer Trail exploration project in Utah, and we have the Larder exploration project in Ontario, Canada. So looking at our 3 assets here, as I said, Juanicipio in Mexico, it's a high-grade silver deposit. It's got a 4,000 ton per day nameplate. It produced 9.3 million ounces of silver last year. It'll produce significantly more than that this year. Think about Juanicipio as in production, good margins, good cash flow, 5% of the property has been explored. It is still an exploration story, but generating cash to enable us to fund our strategy going forward, which includes exploration at Deer Trail in Utah, we're earning in there for 100% of the property, and the Larder Gold exploration property in Ontario, Canada. So the opportunity at MAG is we have a great asset in the best place in the world to have a silver mine with Juanicipio in Mexico. It's a joint venture with Fresnillo PLC, the world's largest silver producer, as the operator, which gives us some really strategic advantages there in Mexico. And we're very much organic growth driven by exploration at our three assets. And we're a silver company. 75% of our revenue comes from silver. Another 10% from gold to give us 85% precious metals, a very strong balance sheet, very tidy capital structure. So our model is Juanicipio production plus exploration at Juanicipio in Mexico, Deer Trail in Utah, Larder in Ontario, creates value for shareholders. We just released our 2022 sustainability report. We're making great progress in terms of our commitment to sustainability. Here's a picture of the operation in Mexico. It sits in the Fresnillo Trend, preeminent silver district in the world, and we've had a big year. We commenced milling in January of this year. We announced commercial production. In June, we achieved nameplate in the third quarter, and we have now shown free cash flow generation from the property. Very good production profile. It's an extremely high-grade deposit, and you can see in the bottom bullet here, less than $10 all-in sustaining cash costs for Q3. Again, not even in an optimized state yet. This is what makes it special, the high grade, 550 to 650 grams per tonne silver in that red bonanza zone. Very long mine life. It's unique because it's sitting on top of an upwelling zone, and the exploration story here is we think we have more upwelling zones on the joint venture ground, and the challenge has been having a discovery in hole 1 in 2003. You can see here in the middle, we've only explored 5% of the property in that top right-hand corner where we've found the Juanicipio vein and now the Valdecañas vein. And there going across the bottom, you see the history of us turning forward-looking statements into facts with the discoveries here at Juanicipio. Looking at going up to Utah, here's a picture of the Deer Trail Mountain. Another great location, like Juanicipio for silver. This is a great location for polymetallic carbonate replacement deposits. We're just down the road from Bingham, Tintic. We sit on the same trend. We use the Bingham as a model, a porphyry hub, which everyone knows about, the Bingham Canyon Mine, but also high-grade silver mantos coming off that as spokes. And that's what we're looking at. We're looking to find these red high-grade spokes. We're on our fourth drilling campaign now. We've had significant success in terms of understanding this system, and we will continue to drill towards a discovery here in Utah, then up at Larder in Ontario. This sits on the Abitibi Greenstone Belt. Bang! Again, another location slide. Here we have a 7.5 kilometre open stretch of the prolific Larder Cadillac break. You can see a litany of historical deposits there. And our opportunity here is deep drilling. There's no deep drilling here. In this area, people know you have to drill deep to get the good grade, and that's what we're doing at the moment. So as we go forward, Juanicipio, free cash flow, it funds exploration. We've got 3 properties with a great chance of exploration success. Thank you for your time.
Well, we're back. I hope you enjoyed that. Some of you already know the material. Let's go. I want to point out that is a favorite company of mine. We're having them present again for us in February, and I believe it should be a double by the end of the year, or even from last year. It's an excellent company. Silver's undervalued, in my opinion, and even if it doesn't go up, there's exploration potential. It's got excellent management, good properties, all the reasons you want to own a stock. So if you wanted one of the mining stocks, and only one, when I would not recommend only one, I have quite a lot I recommend, this would be one that I strongly suggest doing some research on, and if appropriate for you, it is a $1 billion company, you can get it. Okay, let's go a little bit to the astrology again. We've had this before. Jupiter and Saturn, and this is, again, most of you are not into astrology, so this is a broad overview. Just, we're not going to spend too much technical. But basically, there are 20-year cycles with the outer planets of Jupiter and Saturn, which represent the business cycle. In the year 2000, the concept was we were going more global, and telecommunications became important. As of 220, the cycles changed, and we had deglobalization, decentralized connectedness, the internet, space exploration, robotics, AI, all these points. And what I find amazing is you think about it. Why is there only space exploration going on now? What happened from the time we went to the moon? Why did it not go on? From my viewpoint as an astrologer, it needed this particular aspect to do it. So there are big changes, and this is the big one. One of the big ones. So the top down, first level. Second level, there are 4 facts. This is a very important slide, especially for the astrology people. For the rest, just think about the terms. Pluto return for the U.S. is what we're seeing, almost like a civil war. It's a rebirth of the country. And it's a phoenix, hopefully, or a scorpion, depending on the symbol you like. But basically, this is going on for a couple of years, widely from 2020 to 2026. So whatever direction the U.S. takes, and we all have our choices of what we want to see, it's not going to be somewhat finalized roughly until about a year or two after the election. So this is the big picture that anyone could have talked about. I could have told you this about in 1968 when I first became a professional astrologer. I could have talked about it. Similarly, the Aquarian phase, and probably 1/12 of my audience are Aquarians, that Pluto is also entering Aquarius, which is bringing out a number of the themes. And we'll talk about 1 or 2 that I find interesting. But the difference here now is, unlike, there are 4 eclipses, only some of which we find important. The spring one, accompanied by Jupiter-Saturn, which is like how we got to the moon, suggests very positive. Now, forget April 20th. It's going to be within a month or 2 of that time. You have to break it down. But this makes us somewhat bullish. And I find that difficult because I'm a cosmic value player. You can hear this, right, Mark? Yeah. Just checking. I'm a cosmic value player, and I think things are too expensive. So if the markets are this high or higher, they can go higher, but I'm going to have a difficult time. I'm hoping that the markets come down. We're going to play it. If they're not going down, we'll have to be hedged long short, which I'll talk about. So this is, I think, a fairly positive eclipse, and we'll push the market up. Then we have 2 dates, which from other people think, which are around like birthday and August 19th and around December, when the markets could have some negativity. We have to do some research, but it's a Jupiter-Saturn square, which suggests some changes, again, within a few days. But what is of concern is what's happening post-election next year. The Saturn-Neptune aspects, which are a rock on a cloud. 2 examples of them was when the Berlin Wall fell, which was not necessarily a bad thing, but was a big change. And the other one, for those of you that are into mining, was the Bre-X. We predicted the Bre-X disaster about 2 weeks, actually a month before, but got our clients out 2 weeks before it hit, because the Saturn-Neptune went right on Bre-X's horoscope. Obviously, this doesn't apply to everybody. So there's going to be certain fantasies that are going to be destroyed, because Saturn is, but also, it can also mean realizing your vision, realizing things, your imagination, or it can be a rock on a cloud. It has 2 sides. We'll talk about it more next year. I'm a bit concerned, but it could mean that markets will not collapse this year, as they may or may not. They could postpone it, or they may not. So we'll talk about that as we get closer to those times. But those are the 4 big things. And Aquarius, by the way, on the good side is the brotherhood of man. On the bad side, it's a very Orwellian police state, and you can see we have that. And one of the cute things about money, I like to quote, is that negative, and of course, there are a lot of positive Aquarians as well, but a negative trait is it's to live on someone else's money. So I think it's a little bit of communism, or socialism, that they think they deserve at least a percentage for being your friend or being on the planet. So it's a very Aquarian thing, which is why we have a lot of socialistic and communist tendencies at the moment. we won't get into politics because I'm sure our audience is mixed. Some have views one way, some the other. But what is clear is that things are changing, and it's going to be the Chinese curse, very interesting times. What was interesting in the Vedic astrology, which we talked about a bit earlier with why we had the two incidents with the financial crisis and with a bloody 9/11 event for Israel, was they expected it to go to about 80,000. It performed very well. It went to about 72, which is pretty good if you look at the chart. You did very nicely. We don't have their view yet because it comes from the Times of India, and they publish that in the first week of January. So you can look that up yourself, what is published in the Times of India. Chinese astrology, perfect. Trading market was the rapid. And if you look at the returns, they've been almost since all pretty positive. So they did very well. So it was a positive market. The Chinese astrology did well. And what they're suggesting is also positive now, because the water dragon is a positive element, luck, wealth, power. Of course, lots of challenges, conflicts. And as we've talked, we're not as negative on China as some people are now, although there are serious issues. But after we get to the first quarter, again, Chinese markets may be doing better, although they're obviously more risk than elsewhere. The FOC calendar, we're going to have to just look every day, and we're going to have to trade it before and afterwards. We do that. If we continue to do that, we'll try to post it on our Twitter account. But obviously, each of those are important. We think that there'll be 2 at least, and maybe 3. Could be 4, but I'm expecting 2 of them, which would be May and September. There could be others, but we're going to look at where the markets are, how we play them, very close. So those are dates, obviously, that we're interested in as traders. And we like to deal with fundamental valuations, which change. So it's not fixed. This is not going to last all year. At the moment, copper is in a correct level. We should have bought half at 360. We didn't, but we still could go down and get another chance. Gold keeps moving up, but I'm sure it'll be worth 2,000 relatively soon. And silver is in a trading range where it is slightly undervalued. What do I think overvalued, in my opinion? Oil. So even though it's down today, we've been making repeated trades for $1 or so, it going up, and we think for the first half of the year we'll be playing that. As we get closer to the U.S. election, both seasonally and because it's an election, we'll generally be, we probably would be shorted, but not necessarily, because if there's a risk, we could have a $20, $30 move against us. So, but at the moment, we're continuing buying it on weakness. We think both the S&Ps or NAS are highly overvalued. So what we do is we trade them from technical resistance levels. Usually make money the first day. Fortunately, we take half, and the other times we've been stopped out quite a bit. So we're doing that. In bonds, we have a different view than most people. We think the bonds, which are now lower, basically should be higher, at least over 4. And that will determine, because we think things are sticky, but we do admit and we do see that there will be deflation as well as inflation, and the market may choose to look at that. But it's not a stronger play. Technical analysis, we always look at 50 and 200-day moving averages. So they're well below where we are, and therefore most computers are very comfortable. And we held the tests before of the 200-day moving average, and that's one of the reasons markets are up, since long-term players are not concerned at the moment. So what are our strategies? Most important, we want both inflation and deflation protection, both. We like gold and hard assets. We increasingly like private equity, if you can do it. The problem with private equity is a lot of it's still too expensive. We're going to be trading and buying if bonds go way back up again. Now, nobody's talking about this. I think there's a chance there is. Now that it's below 390, we're going to be shorting it periodically, but probably just for a day or two. because we don't think it's going to 3%. We think it's going to go higher. But the selling is going to be tightly stopped. Whereas if we get back up, we did have this numbers last year. We didn't short it. We didn't buy it then, which some people we had did because the numbers were clearly correct. But we don't buy and trade everything, A, because we're busy, B, because we just don't have that much money. So again, who will benefit from, who has pricing power for safety? And if we do go into a recessionary environment, which I think some people will see, then, and especially in the retail environment, who can survive and who will prosper? Because these are always opportunities. A lot of people made money in 2001. A lot of people made money in 2008. And a lot of people are going to make money. Some are making it now. But I think if it goes like we did in October of 22, I think we're expecting it again, and we're positioned for it. And of course, some REITs. But again, I think it's too early for San Francisco hotels and a lot of U.S. commercial properties. They're just going to give back the key. But if you have lots of money or play the right REIT, I think you can make money. A little early there. So that's number one. Excuse me, wrong key. Number two, distressed investing. Again, we haven't seen the distress we expected, but there's some. If you have the capability, and that was when we were playing earlier stocks that fell out of bed at 52-week lows. We like a lot of distressed biotechs. Not all of them. Many of them are going to stay out of bed. But if you saw things at 90% down and they didn't go out, and we have one like that we like, then I think it's worth playing. Alternates, venture capital, real estate, private equity, commodities, and private debt. These are all areas we like personally. However, if you are not an experienced investor, be very careful. And be careful of hedge funds, CTAs, private equity ETFs, because I think it's better to be safe than sorry. But if you look at one with a good track record, it makes some sense to put some money in them, in some of the public vehicles. But this is obviously a lot of risk here, and we like to make more money with less risk. So unless you're doing it yourself, turn it over to professionals and only a small portion of the money that you want to invest. But enough to make money. Because remember, previously in 2008, all the hedge funds were left, almost all the hedge funds had not been hedging properly. They went down as well. So you got to be careful with the long-term track records, and again, do this with your advisor or be experienced yourself. What we're going to be doing a lot more of is day trading and long-short positions pairs. We're going to be doing shorts. We did yesterday. We're going to be doing it again today. We'll do it all next week. But after January 10th, if we're not in the money and we're not stopped out, we'll be doing long-short pairs. So between now and January 10th, every time resistance like we did yesterday was, I think, 48.14 on the S&Ps. Today, again, we did it. Earlier, it was in the top. I haven't looked where the market is now. But we're going to play it at least to the 200-day moving average. I'd like to see it lower. And again, we'll be buying select things such as gold, silver, and oil on weakness. No matter what, it's trader's paradise. No matter what, you can make money almost every day going long or short. Look at the difference between today and this morning. But you almost have to take your money right away if you're trading it, because again, it's a bifurcated market. Our personal view, because we're not a computer, is we buy or hedge from our investing view. So if we think something's undervalued, we're going to play it from the long side. If we think something's overvalued, we're going to short it. Obviously, if you're doing a very hour or two short, you can play it differently, but we like to be somewhat risk averse. How do we do our selling? We have a series of positions. We like to buy or sell ideally from the second or third resistance, the second or third support. Why? Because if we're wrong, the cost to us is less. If we take yesterday, for example, we had, I think it was 48.14, and then we did it at 48.26, which was the second one. So if we're taking it from certain numbers, it's less risk if you're wrong. If the market builds in all the news one way and you think if it's different the other way, your risk is a lot less than if it's not built in. So again, we choose direction of that, and we look for compelling valuations if we're buying. If we're selling, we look for compelling overvaluations and whether people will change their mind. And one of the places we looked at during the year is 52-week lows or 52-week highs, obviously. So that's how we like to do our day trading. We give some examples of it, although we don't give the specific things except for a few clients, but just what our general views are. Then we have a plethora of sectors which you can do ETFs with. The stressed debt, of course. AI and robotics and space technology obviously is done very well. Natural resources, where's the area we specialize in, tend to do in a weak market 30%, but up to 60% other times. Safety, security, and defense obviously has done well. Oh, they're going to downgrade it a little bit because I think we're running out of money, but it's done extremely well. Gold and entertainment, which were the Depression era favorites, we like. I don't think we're going into depression, but we do like those things. Obviously, digitalization, obviously decarbonization, obviously art and blue chips, and always special situations. And my little fun thing, my collectibles, we always like to say, since I'm a wine writer, we like to do as they used to do in the 1920s with fancy people, lords. They would basically buy 2 bottles of a classic vintage in France. When the price doubled, they'd sell one and drink the other. Celebration. That to me is the way to live, if you could do it. And of course, you should ideally buy art because you love it, not because it will make you rich. Usually you're buying it when you're rich. But, I mean, there are good art funds. However, a lot depends on the Chinese, too, because first it used to be the Russians and the Chinese and the Saudis. So it depends, is the money going there? So, but it should be something you love. Just like ideally, if you buy stocks, it should be with the Peter Lynch principle, buy what you know and love, as much as possible, not necessarily everything. And you don't necessarily have to trade it, but you should buy what you know and love and wear it wear your portfolio like you wear clothes. This is the most important thing, to be cat-like. Accumulate, buy what you like on weakness, your favorite stocks, your favorite commodities, and private equity and special situations. And the other thing is, I didn't put in here, but many retail investors are very good at buying. In fact, they very often buy things sometimes better than I do, but they're not good at selling. Know when you want to sell, if you want to sell, or write calls, I think is important, but it's not a subject now. So now we're going to talk about mining picks. We're going to give you a few examples with just 5 minutes I think you want to look at, and then we have a whole bunch of things at the end to talk about, as well as questions and answers. As you can see, there's a lot of things. So today there are good buys, even if the commodities go down 10%. We put this up on our YouTube account. We do it a couple of times a year, not often. And if you have a company that you're tracking at the right price and the right time, go for it. And we do this at our luncheons in New York as well. We've talked about this gold seasonality. As you can see, it's going up, at least into March. We think it will stay longer up. Investment picks, I tend to do less of the bigger companies that are multi-billions, but the 3 that we like are Agnico Eagle, DRD Gold, which, by the way, once a year presents for us and is an excellent ESG company for those who have that issue. It's excellent in terms of recycling and reducing risk, even though it's a South African company. Wheaton Precious Metals, also very well. We thought Nevada had a deal with them, but those of you who track it knows what happened with their situation in Panama, but we'll probably go back on our buy list at some point. Now, we have 3 companies in different sizes. Obviously, the higher the market cap, generally speaking, the less risk, but not always. And 3 of them, EMX Royalties and Victoria Gold and Goldterra will be presenting, but we have others that we look at as well. leave it on the screen a little bit, and you can copy this later. These are all good companies, in my opinion. These are all long-term holds for us, and unless they at least double or triple, and then we have to look at what's happening, we wouldn't sell. So these are generally things we're not selling for 50%, the way a trade would be. So now we're going to go to two companies. The first is Victoria Gold, so I have to mute myself, and I'll put them up in a second.
Hi, my name is John McConnell, President and CEO of Victoria Gold. Today, I'd like to introduce Victoria as an investment opportunity. There are really 5 highlights to Victoria. Number 1, we're now an integrated mining company. We have the producing Eagle Mine in Canada's Yukon Territory, where we'll produce over 160,000 ounces of gold this year. We also have the development projects, Brewery Creek and Raven, and we have exploration projects, Lynx, Clear Creek, and Gold Dome. Number 2, we're forecasting year-over-year production growth. Number 3, we're highly levered to gold price. Number 4, we're delivering on ESG. And number 5, all of our projects are road accessible, so very much permittable. Over the last month, we've been developing a number of what we call 1-minute videos. Now I'd like to show you the first in the series, which is mining operations at Eagle. I hope you enjoyed that video. We have a whole series on our website. Please go to vgcx.com and you'll find a number of very interesting videos. Also, if you'd like, you can send me an email at ceo@vgc.com and we can set up a one-to-one meeting for you to learn more about Victoria Gold. Thank you.
Okay, welcome back, everybody. We're now, some of you know we tend to have problems with computers and technology. You wouldn't believe that I was one of the first Apple dealers in New York and computerized the board event, a little bit of ATT and Federal Reserve Bank, etc. But anyway, we're pretty much out of date, and you can tell that from our website, which is still probably 20 years ago. However, on EMX, the next company, we had some technical difficulties, so I have to present this for you. I'm going to do the slideshow here. And talk about it. This is from, let me put this back. Basically, royalty companies are one of the best ways to make money in the precious metals, because your downside tends to be much more severely limited, and while your upside is not as unlimited, you do have significant upside, and especially with a model that's the way EMX does, which is why we've had them present several times for us in New York. It's definitely a company that's very interesting. So this is a slide deck we had. Of course, cautionary statements, do your own research, blah, blah, blah. Okay, what I like about them is they have a unique business model. They have over 100 partnerships, which means you have very diversified risk. They have the classic royalty generation. They are also buying and selling royalties, and they take equity stakes. So it's different. They own part of companies. So there's a different model than most royalty companies. It's global. Again, that diversifies your risk. And again, you can get the details, but the point is it's everywhere. And obviously some areas are more risky than others, but then you have higher returns. And if you're balancing it out, it's a good hedge. So they diversify geographically, by assets, and also cash flows. All of that, I think, is a good business model. They have copper royalties. They have more precious metal, base, battery metals, all sorts. You can go through these in detail. They create value, and if you look at these numbers, look at the investments on any of these and look at the returns, all of which are highly significant. Now, not every single investment does this well, but the vast majority, to my knowledge, does. They've done extremely well. They create value because of their investments in companies. They have cash flow from producing royalties and other revenue payments. And we can see how small to how much it's growing. This is a growing company. Obviously, with the exception of Mag Silver, which is $1 billion company and also very substantial, these are smaller, but not small. But therefore, there's more upside. And this is a very impressive slide. Look who owns their ownership base. You've got some of the big players from Newmont to Sprott to Franco-Nevada, Stevens, SSR Mining, Adrian Day. These are big players. These are sophisticated players who put their money into the company. And that's always something you want to see, is who else is invested in the company. So it's definitely something you want to take a look at. They have outperformed the junior miner index, and obviously junior miners are higher risk than mid caps, higher risk than the majors, but they tend to do better. And if you look at that chart, significantly better, which is what you want. If you're buying stocks, you can choose a good stock, it will outperform its index. And that's true for all the ones we're presenting. Most of them do that. So I recommend that you contact, as with all the companies we're presenting, go to their website, download the PowerPoint. If you like it, then simply sign up, put it on your trading screen. At some point, if appropriate for you, at the right time, buy the stock. I know. Victoria. Now, this is just a list to show you how many stocks I look at. Obviously, I'm a gold bug. You don't need to track all these companies. But we periodically move them in and out. So there's a lot of companies are watching. I'm a Leo, so it's natural. I liked gold. It came into it very accidentally because a couple of our clients were gold companies, and then we just sort of liked it. So we do track many more companies. Some of these then we move up into our portfolio. So now we're going to talk a little bit about silver, and there are two of them we mentioned, Mag Silver, Desert Island Pick. We also have others that we like, and Silver One is another presenter, as well as others you can see on the screen that we think are all good. But then we have a presentation with them, again a very short one. We don't present too many companies, because if I gave you 50 of them, there's no way you could possibly invest in them all, and you wouldn't actually even outperform. But we've limited to 6, because I think that's a good number of choices. And we're going to now present, before we continue with some more information, we're going to present Silver One. So now I have to mute myself.
My name is Greg Crow, and I'm the president and CEO of Silver One Resources. Silver One is a junior resource company that is exploring for and developing high-quality silver projects in Nevada and Arizona. It trades on the OTCQX under the symbol SLVRF and on the TSX Venture Exchange under the symbol SVE. Now, many junior resource companies have only one project in their portfolio. Silver One has 3 quality projects, each of which could support a separate junior resource company. So let me tell you about 2 of our major projects, more advanced, Candelaria and Phoenix Silver. First, Candelaria. Candelaria essentially hosts 2 open pits and 2 big heap leach pads. Historically, it produced close to 70 million ounces of silver. The last big operator was Kinross, and they shut down in the late 1990s with the collapse of silver prices and sold it off to Silver Standard. Silver Standard did some testing, but silver prices were still low, and they moved on to other projects. We entered into an agreement with Silver Standard in 2017 with the ability to get 100% interest with no royalties back to Silver Standard, now SSR Mining. We completed that agreement in 2023 by placing a $2.5 million reclamation bond on one of the big heap leach pads. We now have 100% interest in the project. Now, there are 43-101 resources on the big heap leach pads. The big heap leach pad shown in the photograph here has about 30 million ounces of silver at the indicated level. A second leach pad has about 15 million ounces at the inferred level. There's also historic resources in ground, down dip from the big open pits, and measured and indicated resources of about 44 million ounces of silver, plus additional inferred resources of another 34.5 million ounces of silver. Infrastructure is excellent. Just off the main highway, 2 miles of paved road with a power line that is active and 2 water wells. We concentrated most of our work in the last couple of years around the 2 big open pits. We did 25,000 meters of drilling. We did some metallurgical testing. And what we're finding is that we have the ability, based on the test results, to increase the recoveries by over 30% to that in comparison with what Kinross was getting when they were in operations in the 1990s. So we're going to move ahead, continue with our metallurgical testing with the idea of putting out an updated resource and an economic study in 2024. Now let's move on to the Phoenix Silver project. Phoenix Silver essentially is getting a lot of attention. Big silver vein fragments were discovered just below the surface. The largest one, 417 pounds, estimated to contain 70% silver as determined by specific gravity. Smaller fragments were assayed, and they returned up to 459,000 grams per ton silver, or 14,688 ounces per ton. These types of values are unheard of in today's silver industry. We essentially have a permitted drill program consisting of 13 drill pads, 2,500 meters, to test the structures which we believe host these rich silver vein fragments. We want to do that in 2024. Now, the project hosts not only these silver vein fragments in the area of the big 417-pound fragment, but we've collected over 250 silver vein fragments, and there are other areas to the north that are yet to be explored. Now, Silver 1 is part of a major northeast trending mineralized belt that includes not only silver projects, but also includes porphyry copper operations, particularly to the southwest of us. Freeport-McMoran's Miami complex is in operation immediately to the southwest, and BHP's #1 exploration target for 2024 is immediately to the south of us. Other operators in the area include KGHM and Capstone, and the Resolution deposit is being explored and developed by Rio Tinto in joint venture with BHP. Now, our project, in the southern part of our project, we have identified veins that carry over 1% copper and some interesting geophysical targets that suggest there could be a porphyry complex under the southern portion of our property. So we want to carry on, drill those rich silver vein fragments in 2024, but also do some porphyry exploration to see if we're part of that big porphyry system that is immediately to the southwest of us. Biggest shareholders include Eric Sprott, over 16.5% interest in our company, other smaller funds, up to 20 of them, and we trade kind of up and down with the silver prices, and we are trading quite low right now, which could be a good opportunity to jump into the company. Now, essentially that said, Silver One is a company with great near-term development exploration projects in two of the best mining jurisdictions in the world. The company is a great hedge on the price of silver, and as these quality silver projects advance, and any exploration success could be instrumental to our shareholders. Thank you for listening. Any questions, just consult our website or call our investor relations person, Gary Lindsay.
We're getting closer here, folks. Let's go on. Give me a second. We're about 2/3 done until we get to the questions and answers, which is, for me, the most important thing. In terms of lithium, we have Ion Energy, and there are quite a lot of others that have gone on and off our list. And with the clean air metals, we had two, but the one we have is the metals company, because last year, that was our single pick outside of MAG, and it was basically a January effect stock. It went from 60 cents to $3. Now it's back to $1. So it is something we recommend, as you'll see a little bit later. But these are areas that I think will do well. We look at aggressive healthcare picks because, as you know, a lot of things like Moderna, Pfizer are not doing well for a number of reasons. So we have two that we like, and we're going to be talking about Jaguar Health a little bit and presenting it. Energy, what we like in energy is getting 5% dividends. So there are a number of stocks that we do, like Riley Exploration, Permian, and Diamondback Energy, which we like, certainly for the first half of the year. Now, with energy potentially going on in the second half, we may write some calls or reduce exposure, but certainly for the first half of the year, and these are good long-term plays as well. So if you're a long-term player, you don't mind a little up and down, we like them. Clean tech and green energy, I keep changing my mind on these because we like a lot of the speculative stuff, and they're a little too risky at the moment. But we do like things like hydrogen, we do like helium, but the companies are not exactly the place we want to buy them yet, but we're constantly watching them. We do like media and entertainment, and remember this, in the next 6 months, and especially in the last 3 months of the year, there's a lot of political advertising. So a number of companies, like let's say take Gray Television, which is a media company, to get tremendous amount of bookings for political ads, and I don't think this year is going to be anything less. So there's a lot of entertainment companies that we like to look at. And of course, you know, Paramount's in play, was one of our picks last year, doing very well. And all these companies the 4 that we catch do rather nicely. Okay. Defensive stocks. You may not like it. We're adding cash because we think cash is important. We've never really mentioned it. We've always said to have some cash levels, but at least for the first quarter, I don't think I'll be having as much cash in the second quarter. It's rather interesting now that people are so afraid of the internet going down that I know a lot of people who are taking $500 to $5,000 and $50 bills and stuffing it under their mattress now because they're afraid that that's going to go down. They're not putting, their life savings and burying it in the backyard, but there are people saying, hey, if the internet goes down for 2-3 days like electricity, you want to have some cash. So it's an interesting situation. The Dividend Aristocrat ETF is a very conservative way to play it, and we like to Verizon a little bit before, a little bit less now. Acme has been a favorite of ours, a good American company that presents for us every year. Now, this is something new for us. This is called our Champagne 5 portfolio. Now, let me start with it's very high risk. And we talk about risk. This is not for your life savings. This is not for all your IRA. This is for speculative capital that is money that you can afford to lose without materially changing your lifestyle. Now, some of these companies, 1 or 2, are very different from that, but we're talking about it. Basically, there's an old saying that we like, he who does not take a risk doesn't drink champagne. So this is the equivalent of the little bit of money you would have put last year into the metals company at 60 cents. If you look at the price of these stocks, a nickel, a dime, 20 cents with one exception, these, we used to say microcaps, which these are non-expiring options, but then we had a couple that expired. So now we say they're long-dated options. So if you buy something for a nickel or a dime, you know what? You can lose a nickel or a dime, but you're not going to lose more. So it's a little bit like your lottery money. Again, some of these companies, as they move forward, are going to be definitely moving out of this range, and I think more than one will. But if you're looking at it now, and again, I have to stress the risk to this, very different from what we had before. It's something that you could have some fun with and look with, but be very careful. I remember one woman who had one of these stocks, and she put her whole IRA in it. This goes back to 2000. And when it went down, she was devastated. So I have to really state the fact that be very careful with it. But they're fun. And it's also when to buy them and when the price. So the first one is the metals company, which is basically undersea mining. When they say we're running out of metal, that's half true, because there's plenty of magnesium, copper, and elsewhere undersea. And over the next 1 to 3 years, I think this is going to be a good winner and certainly go back to $2 to $3, if not a lot higher. It was $10, but it was really way ahead of itself. But 5 years from now, it's certainly possible. Jaguar Health, we're going to have a presentation from, and they basically, we played it once already. It went from 22 cents to 50 cents, and now look at it at 15 cents. We're going to talk about what the company is. It's a very positive situation, but there's a lot of what we see as tax loss selling. If it gets below a dime, I'd worry, but it's a good one. Gold Terry is a company we just started working with. They presented for us many times. It's a nickel, so you can't lose more. I just had to get involved with the company recently because I like it. It's a speculative play. He'll give you all the reasons why. So those two we're presenting for you before we get to our summary, key points, and Q&A. We have a drone company, Volatus, which should be a lot more. I think as they do more investor awareness, that stock will be a dollar stock, but whether it's 1 year or 5 years, I can't say. And then a new one we picked up because of a new company we're working with. It's an emerging merchant bank, and they presented the company for it because copper and gold is a good balance between recession and prosperity. So it's a very interesting company, 6 cents, brand new. Again, it's a merchant bank that we know. We'll be presenting them in New York. We haven't done full due diligence on it, but one of the best analysts we know recommended it to us. So for me, I can risk the 6 cents, but you have to make your own decision. And of course, you have to see if you like this. So again, high risk. So let's hear a little bit of these two companies, and then we'll two of them give an example, and if you like it, go forward. If not, you can watch it and have some fun, but be careful. And hopefully you'll be drinking some champagne. We have some on ice, but we can't drink it until the stock doubles or triples at least, any of them. Okay, so first we'll have Jaguar Health.
Hi, everybody. My name is Lisa Conti. I am the founder, president, and CEO of Jaguar Health, and I look forward to this end-of-year opportunity to remind you of, end-of-year opportunity to... Hi, everybody. My name is Lisa Conti. I'm the founder, president, and CEO of Jaguar Health, Napo Pharmaceuticals. We use those two terms interchangeably. I look forward to this end-of-year opportunity to tell you what to look forward to, and there's a lot to look forward to with milestones and progress Jaguar expects to have happen early in 2024. So we are a public company, and again, we'll dispense with the forward-looking statements just to remind everybody we do all our drug discovery from plants used traditionally in tropical areas. They are natural, organic, fair trade, sustainably harvested, and they are FDA-approved drugs. Our lead drug is crofelemer. The brand name is Mytesi, and it is approved now for the specialty indication of HIV-related diarrhea. Another word for specialty is relatively small, but what's wonderful about crofelemer is that it is a pipeline within a product with a paradigm-shifting approach to normalizing gut function, which gives it the opportunity to have multiple patient populations, multiple neglected needs that it can benefit in the gastrointestinal area. We can't do them all at the same time, so the two that we have focused on are cancer therapy-related diarrhea and rare disease orphan indications of short bowel syndrome and intestinal failure associated with that, and congenital diarrheal diseases in babies, one of which is called MVID. So the most exciting thing and the most important thing that I can tell you, and the thing to remember, is early in 2024, literally just around the corner, we are going to have the comprehensive results for a phase 3 final pivotal clinical trial to expand the indication of crofelemer, which is now approved as Mytesi for HIV, the same formulation for cancer therapy-related diarrhea, and a full collection of gastrointestinal symptoms and chemotherapy-induced overactive bowel, which can include urgency, incontinence, cramping as well. What's very important here is that this was a two-stage trial. The first stage was 3 months, placebo-controlled, 1-to-1, drug to placebo, and then the patients could choose to stay on for another 3 months, but they needed to stay on whatever they were on, and they wouldn't know if they were on placebo or drug. So you would presume if they're having some sort of benefit, they would want to continue. And a majority of the patients, more than 50% in a 1-to-1 drug versus placebo trial, continue to stay on in the phase 2. So we will have the comprehensive results from phase 1, phase 2, and what we're looking for is the satisfaction to the regulatory agency, to the FDA, to be able to file a supplemental new drug application. We have an approved new drug application for HIV, a supplemental new drug application to be able to then educate, promote, and sell for cancer therapy-related diarrhea. This whole trial design, the importance of patient-reported outcomes and neglected need, was very successfully presented in December, just a couple of weeks ago, at the acclaimed San Antonio Breast Cancer Conference. Our trial includes all solid tumor types. Over 60% are breast cancer patients, and we had strong attendance from a couple of dozen patient advocates to really focus on supportive care, quality of life, and in particular in metastatic patients who are on targeted therapies, often for months, years, the rest of their life, many of which have diarrhea associated with them every single day that the patient is taking them. So again, that will be in the first quarter of 2024. We expect those results. The second really important milestone will be for crofelemer in a different formulation than Mytesi for intestinal failure associated with short bowel syndrome and congenital diarrheal disease. These are situations where patient's intestine is not functioning to absorb the nutrients of life, proteins, carbs, minerals, etc., vitamins. And so these patients live on parenteral nutrition, IV nutrition, for sometimes 20 hours a day, 7 days a week. So no quality of life, really catastrophic health implications as well. To give you some idea of how big these neglected needs are, I'm going to focus first on the short bowel syndrome and the intestinal failure. Third parties put this market at about $5 billion in the next 5 to 6 years. And the only thing in the pipeline right now, other than crofelemer, are growth hormone approaches, which have a lot of limitations due to toxicities, but also a growth hormone can't be used in a patient who has a cancer patient, for example, or any sort of abnormal hyperproliferative situation. So totally new paradigm-shifting approach with crofelemer, and expect to see proof of concept data early in 2024. And then the market opportunity for cancer therapy-related diarrhea, as an analogy, chemotherapy-induced nausea and vomiting is about a $3 billion market. And by the way, half that market is valued as a generic at this point. We're talking about something that would be taken every day with targeted therapy. There's about 50 different targeted therapies out there right now, about 24 in our clinical trial. Most, if not all, work by inducing the type of secretory chloride ion channel mediated diarrhea that Mytesi normalizes. So that's the news, that's the update. It's going to be a very exciting 2024 for all our stakeholders, patients first and foremost. Our stock has been hit hard, as many biotech stocks, and we're all looking forward to 2024 to be a buying opportunity for those stakeholders who are shareholders. Thank you very much. See you next year. Happy New Year.
By the way, I'm sorry I used the wrong slide. There was an edited version with the first part out. So that was my third technical error you may have caught here, but hopefully the information you're getting makes it all worthwhile. So next, last but not least, we have a emerging company. This is something we've watched. They presented for us for about 1.5 to 2 years, maybe 3, and it's just at the point now where we wanted to get involved, and therefore we like it. We're going to have them present again for us in New York, but very often we watch companies because I like to do a lot of due diligence and just wait for the right time. For me, this was the right time, and we just got involved with the company. Hopefully you may feel the same way.
Good afternoon. My name is Gérald Panaton, Chairman and CEO of Goldterra Resource Corporation. I'm a geologist of formation, having spent pretty much all my career in the gold business. Today, we're going to talk about Goldterra and why investing in Goldterra, and why I did invest as well myself. But first, going through forward-looking statement. And of course, cautionary statement, as we are a public company for disclosure purposes, you can find part of this presentation on our website in the public domain. Why investing in Goldterra is always like, why do you invest in this one versus the other one? But in reality, it's always about keep it simple. Simple, safe strategy is always a good objective. Yellowknife is existing infrastructure, a town of 20,000 people, a district scale potential to find more gold. As a proof, already 14 million ounces of gold has been produced in the camp of Yellowknife, and it's much easier to find gold near an existing gold camp than it is in the brand new nowhere. Drilling in 2023 will amount to 10,000 meters, and we've been spending drilling and money over the last 4 years since I joined the company. Our track record, we're good at executing, from exploration, from development, proving up the reserve and the resource, and of course, building the mine and developing the mine. We've done it. But what's important about the potential is the district scale. It's very important to realize that only a small portion of the property was explored for gold between the Con and the Giant mine. And there's vast amount of exploration to be done north and south of the mine. For example, we already outlined 1.2 million ounces north of town. And the core of our current drill program is on the Con mine, where we've already outlined 500,000 ounces plus, where there's already 600,000 ounces left at 12 grams in the ground, in the mine, plus all the potential in the down plunge. Very importantly, when you look at what's available, and it's a good slide to show the potential of Goldterra, is a snapshot of Yellowknife. Our main asset, the Con mine, where we're exploring to define more than 2 million ounces of gold, is in the heart of town. Everybody goes home at night. It's much cheaper in terms of access, workforce, hydropower, airport and roads. This is a town that allows you, for every employee that would work at the mine, to go home at night, like we're doing now. The cost of drilling, $200 per meters. A safe jurisdiction, because we're basically in Yellowknife, Canada, in a very stable environment. Plus, the experience of doing mining in the past accounts for a long-lived experience in town in terms of mining and developing projects. And what's very important is the valuation of our company. Currently, at $20 million market cap, it's a value of roughly $7, $8 US per ounce. We call it a call option on gold. If we find a lot of gold and we de-risk the project as we move forward towards gold production, we will eventually get into a gold production. Or making money for shareholders also include de-risking the project from exploration, resource, into reserve, into production. If you have any further questions, you can find our address and communication on our website, and we look forward to hear back from the audience. Thank you very much.
Well, we're near the end, almost ready for questions and answers. We're on time. Let me go a few more points. Look, why is this? I know, but my thing is not going down. Let's see why. Okay, just want to give a summary, and then we're going to get to the Q&A, and hopefully that will be interesting for you. So, whatever it is for you, 5, 10, even 20% of maximum allocation for precious metals, we think it will do well, or you can think of it as a hedge, either way. Number 2, it's never wrong to buy a classic stock with a cash flow, sound balance sheet, and ideally growing dividends. And number 3, in my opinion, an active, well-managed portfolio outperforms index funds. However, if you're doing it all yourself, it may be too much work. And, you did well. I think it's going to be a difference this year, but either way, it doesn't matter. So, we review. Caution, we still recommend this what we worry when there's so many worries, which is always the case, but more now. Have the ability to buy if markets panic and be ready to buy. There are winners and losers. And if you want to trade, it's trader's paradise. Between yesterday and today alone, you can go retire. We basically have continually a much longer 2 to 3 year horizon, at least, versus trading literally intraday, taking your profit at night, and then either getting stopped out or going forward, or loss. Those happen too. So we're going to get into questions. I hope so give me a moment to organize. We're not the swiftest thing here, so let me take a look where my Q&A is. Okay. Oh, we have a Q. Give me a moment here. This should be in the chat room if you didn't put it there. No sound. Oh, why did nobody have sound? Huh. Well, I'm sorry I didn't see that, but we have sound. You have sound, right? Well, I don't know. I'm sorry you didn't. We should have had that. But where are the Q&A? Usually there's some questions here. Well, let me just see. Let me go into Q&A. Okay, if anyone would like to do that. Wow, it's quiet. Got a lot of people here, although more later. Yesterday, the question is a long-short trade. Now, yesterday, until January 10th, we're mostly doing short trades. I mean, as pairs. So basically, it was an S&P from 4814. Let me just see if I can bring my thing up in a moment. Yeah, okay. It was, yeah. Yeah, it was, yeah, from 4814. And from today, for example, today we did something at, I don't have it in front of me, 47. Let me see if I can bring this up. Give me a moment. We'll try to bring that up. Share. Okay. Mark, can you see the trading screen? Yes? Yeah. So we did this at 86. So we then went short at 47.86 on the S&Ps earlier. Now, if we get stopped out, we're going to do it again. Now, we didn't trade the rest because I'm not actively doing it. But had I been trading yesterday, I would have been in oil earlier because oil's been moving up and then they're knocking it down. So you have to realize that the way the market is, especially year-end, it's very tricky the last 2 weeks, very much like the last 2 weeks in August, which have less and less to do in fundamentals in general. So we would have taken something like gold, which bounced off of 2040, as a hedge. But basically, we're not hedging our shorts on selling them, but we're covering them half each day. And then, but once we get past January 10th, if that indicator says that the market's going to be positive, and I believe there's a good chance of being positive from second quarter on, even if I think valuations are in the sky, I won't be naked short. Okay, 1 second. Get some things here. Okay, getting some more here. Okay, won't trade. Sure, I'm asked about the, unfortunately I don't use Chiron. I was involved in, well before Chiron was considered. I used to deal with Eleanor Bach, who was the asteroid lady that sort of started all this. She used to give classes at our school, but I never actually started using them. I think the Jupiter-Uranus is going to be positive, which is why I made it green. It could be disruptive. Obviously, in the aspect could go either way, but I wouldn't be concerned. I mean, that was like the moonshot. So for me, even though I'm considered bearish, I just consider that I'm realist. I think there's a big risk for the market to go up. Plus, of course, the fact that there's a lot of government interference. I'm being asked about cranking the Indian companies. Yes, there's a lot. I will give that offside. Basically, yes, there is news, but since we didn't discuss it here, you can call me on it. There's a lot of good fundamental news, I can tell you that. The trading part is a little weak. So let's see if there are any other questions. Had a lot of people here. By the way, can you see me? Mark, are you able to see me? For some reason my pictures didn't show. Let me try it here. Nope. Let me try the video again. Let me try something. Before we log off, for some reason, it's one of my 3 errors. We didn't get things. Let me. One second. Let me just see. Do you see me? Okay, was an astrological question. Let me get back in. Can you hear me talking?
Yeah.
Okay. I was trying to get my picture. For some reason it didn't come. I was asked about intraday planets. Obviously, if you're an astrology person, you use the ascendant, you use the midheaven, and you use your inner planets. But you look at their aspects, and obviously Mercury, Venus, and Mars, as well as what aspects they're making. Yeah. But the angles especially. Anyway, I hope I've given you a lot to chew on. A couple of things you didn't just get to see my face. I'll try to see if I can get it up for a moment. I don't know why but you got the most important thing, which is the material. We will put it up on our website, hopefully by tomorrow, since I'm not going to be editing it. And but I will tell you one more slide, which I consider my 5 ones. You know, when you review for next year, this is what I think of my 5 biggest forecasts for next year. Gold, Canada, selling the market, the first quarter, which is not as high a degree confidence, but it's a fundamental play. Buying it is an astrological play, but not a fundamental play. We obviously like to have both. Commodities on weakness, we do have. And then our 2 special aggressive plays. One is our Mad Desert Island pick, and our Champagne portfolio, our super high risk, but not bet the house. So that's sort of where we're at. I don't know why we didn't get to see my wonderful face here. I'll have to study it for August 19th. We will have it up. We do have a Twitter account, and as well as a Telegram account. I'm going to thank you all for coming, and I hope you find it valuable. Okay, we're going to mute.